the Honorable Finance Minister had made an announcement in one of the budget speeches about a corporate debt market development fund, which was to function as a backstop facility for mutual funds in the event of a market dislocation in the bond market. And we're very happy to share with you that that whole initiative has made a very, very significant progress. And therefore, today, the board approved the creation of a new chapter in our AIF regulations to facilitate the creation of this fund. So basically, what this fund will do is it will sit there on standby and just be on standby in normal times. But whenever there is a significant market dislocation which warrants sovereign intervention, so it has to be really something significant, not minor volatility, but a significant event happens, then just like you have developed markets who instantly trigger asset purchase programs, we will have the ability to, with the press of a button, we would be able to activate this fund, and it would go in there and become the buyer of last resort from the mutual funds. This is an initiative which will be initially funded and the corpus brought in by the mutual fund schemes as well as by the AMCs themselves. So very important to know that the AMCs themselves are putting skin in the game, their own money, not the scheme money, but their own money. So this is a very important milestone, both for the bond market and for the debt mutual fund market. So we hope that this fund will now, so whatever regulations were required to facilitate this have been approved by the board today. And so we will very soon see this backstop facility coming to life. It will be managed by SBI AMC, and the entire structure has now been approved. So the initial corpus is 3,000 crores. And the government has approved a 10-time leverage, so 30,000 crores. This 30,000 crores will be guaranteed by NCGTC, which is basically the government's guaranteeing arm. So it will be a sovereign guarantee. So when the button is triggered that we are in the midst of a market dislocation and we need sovereign support, then this entity will go borrow from the banking system or the repo market or wherever against the sovereign guarantee. So it will now have 33,000 crores with which to go out and be a buyer of last resort from mutual funds. Only mutual funds will be able to participate because they are the contributors, and each of them will be eligible to participate to the extent of their contribution, but it will be at a AMC level, not at a scheme level. So if let's say a fund has contributed X amount to that 3,000 crores, let's say 10%, so they will be able to go and sell assets of, if they've contributed, whatever, 300 crores, they can go and access 3,000 crores, 10x.
How will you reach that? You trigger the button.
SEBI triggers the button. The SEBI board will trigger the button. A very elaborate model has been built, analyzed, and approved by the government specifically. Of course, all models are meant to be reviewed from time to time because we expect that this is going to be a very long-term facility. So as and when there are fresh learnings, it would be reviewed. But as of today, we have an approved model. That model will form the basis, but not the only contributor to the decision. Then the board will sit and will take various other qualitative and quantitative factors into account based on that model, model plus other factors, and then decide whether sovereign support is required or not. Yeah, so as I said earlier, that there is, the first 3,000 crores is going to come, the first 3,000 crores is going to come from roughly from my memory, 10% is coming from the equity of the AMCs, and 90% is coming from the those specific schemes which are going to benefit from this. So not every scheme of the AMC, only the schemes who are going to benefit from this facility. The debt funds. And those also, they are specified debt funds.